Understanding the Australian property market is critical to making safe decisions. When we're teaching our clients and giving them advice about how to invest in the Australian property market, or markets I should say, we get lots of questions about what happens if. What happens if there is another GFC? What happens if there's a recession? What happens if there's another 9/11? We shouldn't be too worried about these things, but we should try and understand them. In this graph behind me, it's the Sydney property market with all the major international events overlaid it, or at least the main ones that we get most questions about. So we can see back to 1965, the Sydney property market was about $10,000, and then about a year ago it peaked at about $1.1 million. But all these little bubbles refer to a major international event, from the Vietnam War, the 1973 oil crisis, the last time the Labor government took away negative gearing, the stock market crash in 1987, the global recession we had to have, says Paul Keating, 9/11, the terrorist attack in the United States, start of the mining boom, and the last GFC, global financial crisis. Now what's really interesting, if you look at all the major financial events, the recessions, the stock market crash and the GFC, the property market actually started to grow or boomed, which is a really interesting thing because you would often think the opposite would happen. So why would that happen? So if you can think about what the government tries to do and what the Reserve Bank does during a financial crisis or a recession is caused by low inflation. And when there is low inflation, the Reserve Bank will reduce interest rates. And if you look back at the GFC, interest rates were 8 to 8.8% before the GFC. And within 6 months, the Reserve Bank dropped interest rates down to 5%. The cash rate was about 3% and the banks were charging about 5%. Unemployment only rose between 1 and 2%. The natural unemployment rate is normally about 5-ish. So if unemployment only increased by 1 or 2%, the other 94% of people had interest rates reducing from 8% down to 5%. So if you can think what's going to influence the market most, 94% of people having interest rates almost halve, or 1 or 2% of the population being unemployed, then the affordability of lower interest rates has a much stronger driving force than unemployment. And that's why in just about every economic downturn, the stock market crash in 1987, you can see the market boomed. The global recession we had to have was the start of the previous property boom. And then the GFC, well, there's a very short period of negative growth. That was almost the perfect time to start investing in Sydney property. Now, of course, the other really topical issue is what happens when they take away negative gearing. And if the Labor government get in the next election, if it does get through the Senate and be made policy, what might happen to the property market? Well, you might have heard that the Labor government had already taken away negative gearing in 1985. So not only did they take away negative gearing, they changed the capital gains tax rules and they increased how much capital gains tax would be paid or reduced what they call the capital gains tax discount. Now they only kept that policy in place for about 1.5 years, 2 years before they realised how much damage it was doing to the broader economy. So then they reversed the policy and brought negative gearing back in. Now you can see though, it didn't decimate the property market at all. While it was moving slow, the rate of growth actually probably increased a little bit. And if you looked at what rental returns did, rental returns actually increased quicker. And that helped drive affordability and focus on property. But as soon as they reversed the decision, at about the same time as the stock market crash, property started to boom. So there we go. Keep a copy of this, review it as much as you want, but it's a really good way to understand all the what ifs. What happens if we get these events again in the future? It's good to understand how they impacted the market in the past.